Hi guys, welcome back to the video. I'm Luke. Today we're going to be talking about routes that public companies, so companies that are listed in the public markets and shares trade on listed exchanges, the routes they can take to go back to being a private company. There are reasons why public companies may want to go private, and we'll discuss some of those in the video. So yeah, let's get into it. Okay, so going from a public to a private company. So public companies are often taken private through a number of different mechanisms and routes, and one of the main ones that you commonly hear about is LBOs, so leverage buyouts, where debt is raised from a bank or from a third-party lender, and that leverage helps support a take-private transaction. The public company is acquired using a mixture of debt and equity capital, and as a result of the take private, they are no longer a public company. The shares will cease to list on an exchange and they become a private company again. So yeah, a take private or go private process involves investors who purchase all of the company's publicly traded shares, and it also involves delisting the company from their local stock exchange. So as I was saying, a pool of investors will come together, maybe through a consortium or something like that, and they will look to purchase the public company, which will result from it being removed from the local stock exchange. Its shares will cease to trade amongst public market investors and it will go back under private ownership. Often the purchaser must pay a takeover premium, and by takeover premium I mean more than the market share price. So if you go to your local broker and try and buy Apple stock, for example, that would be the market share price. If a company or group of investors wants to acquire a public company, they would typically have to pay more than the market share price, which is known as a takeover premium, also commonly known as a control premium. So there's benefits associated with controlling or owning 51 or more % shares in a company, such as having control over it, etc. So you often have to pay a premium, typically in the range of 30 to 60%, depending on the company, over the market share price to take the company private. And yeah, in the case of an LBO, but often in many different types of public to private transactions, debt is often used to help fund the acquisition. Okay. So let's think about the stages in a public to private transaction. So let's start with what actually happens at transaction initiation. So step one, the acquirer purchases a public company. So we have the acquirer, which could be another company, it could be a group of investors, and we have the public company itself. So those are the two obvious participants in a public to private transaction. Who else is involved? So we obviously have the public company shareholders, so the existing shareholders in the public company, and they'll own 100% of the shares. The other key participant is the bank. So the bank will often provide a bank loan or debt capital to the acquirer to help support the acquisition. And the acquirer, using a mixture of debt and equity capital, will purchase the shares in the public company from the existing shareholders. And then as a result, if the transaction goes through and completes, ownership in the public company will transfer to the acquirer and the company will become private. So step two, the public company is taken private. So quite simply, the acquirer, again, that could be another company, it could be it could be investors, it could be a private equity firm. Will now own 100% of the shares in a private company. So notice, private company. It's no longer public. So that's really the two-stage process when it comes to investors who are looking to take private a public company. They will typically use a mixture of debt and equity capital to buy out the existing shareholders, and they will take ownership of the company, delisting the public company shares from the local stock exchange and taking the company out of public market view and turning it private. That's literally the two stages behind the mechanics of a public company going private. Some other points here that are important to note for the exam. Take private deals are initiated by investors who feel the company is undervalued by the public market. So if the acquirer feels that the shares in the company are trading at too low a level and that they could take actions in the private market while the firm is out of the public view and subject to lower scrutiny and regulatory oversight that can improve the value of the company, then they feel they'll be able to make financial returns from doing so, which is kind of the key motivation behind doing this from an investor's point of view. They may feel that the company's just being completely undervalued by the public market. They're under pressure because of their regulatory commitments, their disclosure requirements, their distracting management. And they feel that in the private market, where the business is subject to significantly less in terms of scrutiny, and under their ownership, they can improve the value of the company. So that's one of the key motivators behind doing such a deal. And yeah, these actions to improve company value could include changing the senior management team, so changing the chief executive and the board, selling off long-term assets, so realizing proceeds from selling off some of the firm's either operational or non-operational assets and reinvesting those cash proceeds elsewhere in the business, selling off business divisions, so yeah, restructuring the firm, changing its composition, its business mix, making redundancies maybe, by cost savings. These are all different actions that are typically undertaken under new ownership in the private market. And if the value created from realizing all these actions, aggregated, so you undertake all these actions, you add the value realized from undertaking them, add them all together. If that exceeds the takeover premium that the investor paid, plus the costs of financing, so the costs of debt, if that's the case, then the investors will make a return. So if the value delivered by undertaking a restructuring, by changing management, selling off long-term assets in the private market is greater than the takeover premium plus the costs of financing, then that's a good deal. The investors will make a return and value will be created by undertaking the transaction. If the value created by undertaking those actions is lower than the costs of financing and the takeover premium, then that's a bad deal. The investors in the transaction will make a loss. And then once these steps to restructure the company have been completed and value has been created, the exit route for investors is typically to take the company public again. So once the company's spent a bit of time in the private market, they've restructured it, they've created value under the new ownership. Once the investors feel like the company is ready to be sold and they want to realize their return, they will undertake an IPO. So they will typically take the company public again once it's ready to do so, and once they're able to achieve their desired valuation level. So it sounds a bit strange, but you're basically taking up a company that is currently public, private, to restructure it and improve it outside of the public view, whilst it's subject to less scrutiny and oversight. And once the company's ready, we've improved it operationally, the investors are happy with the performance of the company, they'll take it public again and hopefully realise a financial return from doing so. So that's everything I wanted to discuss. That's the route public companies take to go private. There's some rationale there as to why investors would undertake such a deal, why they would want to take a company public, and what the value upside looks like from doing so. Any questions, feel free to fire them off in the comments, and I'll see you guys in the next video.